Traders spend many hours trying to learn about trading and investing. They read books, they read articles online, and they also watch many YouTube videos with a hope to gain more knowledge. But when the time comes, a trader has to analyze the market, identify a trade, and pull the trigger. But they shy away. They often look for market analysis videos or online notes to help them identify what they should be doing in the markets the very next day. This dependency on other people's market analysis is not sustainable, nor will it help you grow as a trader. If you're serious about a career in markets, then you will have to figure a way to analyze the markets on your own and come out with your own trading decisions. With that in mind, we are doing a two-part video series to help you develop a framework to analyze the markets at the end of every single trading day. Hi, this is Karthik Rangappa, and welcome to part 1 of Do Your Own Market Analysis series. Market analysis can be done in multiple ways. In this video, I'll share a simple template using which you can figure what's happening in the market and position yourself for the next trading day. You can use this template to get started, and as you gain more experience trading the market, you can analyze your own trading behavior and tweak this template to suit your needs. Ultimately, I hope you will stop depending on others to guide you in the markets. But a word of warning here. A typical market analysis involves looking at multiple data points. Never will you be in a situation where all the data points leads to the same conclusion. There will always be mixed signals, and this is where your experience as a trader kicks in. You will have to figure which data point to assign more weightage compared to the other data points. To develop the overall understanding of the market, you can divide your analysis into two parts, the macro view and the positional view. A macro view, once developed, will stay valid for some time. But as an active trader, you may want to revisit the macros every week to see if there are any new developments. The positional view, on the other hand, helps you develop a view on the markets on an immediate basis. Think of it as a plan of action for the very next trading day. In this video, I'll share with you a template to develop a macro view on the markets, and in the next video, I'll talk about the positional view. When developing a macro view, it is always a good idea to develop a very high-level understanding of the macro parameters. This perspective gives you a sense of where the markets are headed. This high-level market analysis helps you keep things in check and position yourself properly in the markets. For example, if the macro view reveals that the broad markets are weak, then you know you should go easy on your long positions, or perhaps look at your short positions more favorably. Let me put this in perspective. Assume you're on a trek and descending a mountain. You know the overall descent will be painful on your knees. You must watch your steps and walk slowly. Walking slowly is how you position yourself on an overall basis until the descent is complete. But while on the descent, if you hit a flat patch, then that's an area where you can walk fast and gain some speed until the downhill starts again. This is the short-term strategy which still fits within your overall plan. Alright, with that in place, let's get started with laying down the macro template. Always start with the GDP numbers. I like to see the RBI's estimate of India GDP and contrast that with what the World Bank expects. RBI's view on India GDP matters because that kind of dictates all the monetary policy decisions that RBI would make. World Bank's India GDP forecast also matters because that kind of impacts all the institutional inflows to the country. At the time of recording this video, RBI maintains that India GDP will grow at 7.2% for the year 2022 and 2023, while the World Bank recently cut India's GDP forecast to 6.5% from 7.2% for the same financial year. In April 2022, RBI slashed the GDP numbers from 7.8% to 7.2%, which RBI still maintains. It is important to note what RBI thinks because it gives us some insight into what the mood is inside RBI's boardroom, which, as you may have guessed, will impact the monetary policy, which of course has a significant impact on the stock markets. When thinking about GDP, look for factors that will influence the GDP growth. For instance, if the monsoons are good, then that will have a positive impact on the GDP, as a good monsoon invariably leads to an uptick in rural consumption. So the very first thing in your macro analysis should be a view on GDP. If both RBI and the World Bank thinks that the India GDP is on an uptick, markets will be bullish, bearish otherwise. Next up is inflation. I've done a detailed video on how central banks control inflation. Do check it out. But when you think about inflation, you'll have to consider crude oil prices. RBI has a target price for India crude oil basket. It's about $105 per barrel at the time of recording this video. If the price of crude oil increases beyond a certain level, then that will have a negative impact on the forex reserves of the country, which in turn will have an impact on the inflation. Of course, you can extend this argument to other international commodities as well. Next, when you're looking at inflation numbers, also pay attention to the consumer price index. One factor that influences the consumer price index is the food price, basically the price of vegetables and cereals. This is a very sensitive data point, as an increase in food price almost has an immediate effect on the inflation numbers. RBI is comfortable as long as inflation is within a certain band. If the inflation starts to break the upper threshold of this band, RBI starts to increase the monetary policy rates, which the stock markets won't like. So do keep an eye on inflation and factors that influence inflation. Keep track of the US dollar index and also the USD INR pair. A weak rupee is particularly not good for India because India will have to shell out more US dollars to procure commodities, especially crude oil. I would encourage you to read the Commodities and Currency module on Varsity to get a better understanding of these things. Another factor which is equally important while developing a macro view is an understanding of the geopolitical situation. Things like Russia-Ukraine war or the tension between China and Taiwan matters as they have a multifold effect on many things, including commodity prices. Again, if commodity prices increase, then the inflation also increases, and that has an impact on the monetary policy rate. Stock markets like a stable government. You also need to keep an eye on the local political situation. You need to keep track of things that will lead to an election. Any instability in governments, especially in Maharashtra, UP or Rajasthan, has an impact on stock markets. Let's take a pause and quickly summarize all the things we've learned so far. As an active trader, you need to develop a macro view and determine how the market is positioned for long term. Look for GDP growth forecasts from both World Bank and RBI. Keep an eye on inflation and monetary policies, factors that drive inflation up. Keep an eye on commodity prices, especially crude oil. Also look for the dollar index and the USD INR prices. Monsoon and its impact on inflation. Track CPI and food price inflation. International and domestic political situation. Apart from all these things, watch for the US markets and the Federal Reserve's Monetary Policy Action Plan. The US is the mother of all markets, and any turmoil in US has a ripple effect on all the other markets. I know all of this may sound a little complex at this stage, but trust me, it's not. You may have to update yourself on a weekly basis, and there is literally no need for you to spend time on these things on a daily basis. Alternatively, maybe you can spend about 15 or 20 minutes reading the newspaper daily. That also helps you develop a macro view. Also, a good practice is to maintain a macro scorecard or a journal, where you update your thoughts on what's happening in the markets and the directions in which the markets are moving on a weekly or a fortnightly basis. If you have time at your disposal, I would highly recommend you read RBI's Financial Stability Report or the FSR report, which gets published once a quarter. It is a super simple read and gives you a perspective on all the essential macro indicators. We are not done yet. Apart from developing a macro view, we should also check how the stock market is positioned from a price perspective. Sometimes the macros can indicate doom and gloom, but the markets could have factored in all of it. Remember, the markets are always forward-looking. A quick check of how market is positioned with respect to a 200-day exponential moving average perspective is quite helpful. A 200-day exponential moving average is a great indicator of the long-term market trend. In fact, I know traders who only look at the 200-day moving average and ignore all the macros. Their rationale is that the price eventually reflects the ground reality, hence evaluating the 200-day EMA serves as a proxy for macro analysis. I personally don't subscribe to this thought. I like to evaluate both the macros and the 200-day exponential moving average to get a sense of the long-term sentiment in the market. Now remember, the macro and the EMA analysis that you do should result in one of the following outcomes. Either the market should look outrightly bullish, or the market should look bearish, or the market gives you a mixed signal. For example, the macros indicate doom and gloom, but the prices on the other hand are trading higher than the 200-day average. If the outcome is outrightly bullish, then I load my long-term portfolio and ensure all my capital is invested in equities. On the active trading side, I'd probably get more comfortable with long or bullish trades via futures or selling deep out of the money puts. If the outcome is outrightly bearish, I'll start looking at selling opportunities on a stock-specific basis. And I would definitely not be comfortable adding more stocks to my portfolio. On an active trading side, I would be comfortable with short trades via futures or by selling out of the money call options. If the macro analysis reveals a mixed signal, then I'll invest 50% of my cash in equities and let the other 50% remain in cash. I'll see how the market evolves. If there is an uptick in the markets, I'll invest the other 50% in equities and average out on my winning stocks. Remember, averaging on a winning stock is always a good idea. On the other hand, if the market starts to slide, I'll sell the 50% that I had invested in equities. At least I'll be glad that I have 50% in cash. Remember, what we've discussed so far is a template to do a macro analysis of the market to help us understand how the market is positioned on a long-term basis. In the next video, we'll try and understand how to develop a positional view on the market. A positional view helps you develop an action plan for the immediate trading session. I'll see you guys in the next video.